Let's talk about AI. The revolution is absolutely here, and you've seen it. The markets have gone completely wild for it. But what happens if all this hype outpaces reality? Today, we're going to do a deep dive into what an AI bubble bursting could actually look like. We'll go from the very first trigger to the global fallout and, maybe most importantly, where the smart money might go once the dust finally settles.
And we're not starting small here. I mean, look at this. When a huge institution like the Bank of England says an AI shock is material, that's basically their code for, hey, this is a really big deal. This isn't just some fringe chatter on the internet. This is a top-tier risk that the world's biggest financial institutions are watching like a hawk.
Okay, so what's the pin that could actually pop this bubble? A market this hot, this excited, doesn't just cool off by itself. There has to be a trigger, right? So let's get into the specifics of what could shatter all this confidence in AI.
Let's just call them what they are, the four horsemen of the AI apocalypse. Seriously, any one of these, all on its own, has enough power to cause a major shock to the system.
You know, the real danger here is how these things connect. First up, you could get earnings misses. That's when investors suddenly wake up and realize the billions being poured into AI aren't actually paying off yet. Then, boom, a regulatory shock, maybe a surprise antitrust lawsuit against a key player. On top of that, you have macro tightening, central banks raising interest rates, and all that easy money that's been fueling tech growth just dries up. And for the real wild card, a huge new tech breakthrough. Imagine quantum computing suddenly becomes real and makes all our current AI look like a pocket calculator. Any one of these could be the first domino to fall.
So the pin finds the bubble. What happens next? Well, it's not a slow leak, I can tell you that. It's an incredibly fast chain reaction that just rips through the entire global financial system.
The second that collective belief in AI is the future no matter what breaks, capital doesn't just walk away, it flees. It starts a frantic, desperate search for safety. And that violent rotation of money out of some things and into others, well, that's the very definition of a market crash.
And this is the great divide you'd see in a crash. On one side, you have a frantic plunge in anything that's seen as risky or speculative. Think tech stocks, the semiconductor companies, crypto, all falling off a cliff. And on the other side, a desperate flight to safety. Money pours into things like US government bonds and stable, safe haven currencies like the dollar and the Japanese yen.
And if you're looking at that number, negative 78%, and thinking, no way, that's just a crazy hypothetical, it's not. This actually happened. This is the exact drop that investors in the NASDAQ saw during the dot-com crash. It's a pretty sobering reminder of just how far and how fast a tech bubble can fall. A crash like this isn't just contained to Wall Street, not even close. The shockwaves ripple outwards, creating this incredibly complex domino effect across the whole world, and the outcome looks very different depending on where you are.
Yeah, you can really see here how the impact just isn't the same everywhere. The US would be ground zero, right? Massive tech layoffs, big stock losses. But then look at India. It could, weirdly enough, actually attract capital that's fleeing the wreckage. Or take Japan. A strengthening yen would be a total double-edged sword. Good for people buying imports, but really painful for their big exporters. Every region would face its own unique mix of pain, and believe it or not, some potential silver linings.
It is so easy to just focus on the destruction, the chaos. But crashes, historically, are also moments of incredible wealth transfer. So amid all that panic, where would a savvy investor even begin to look for an opportunity? Okay, the first step isn't about finding bargains. Not yet. It's about figuring out who the survivors are going to be. Because in a downturn, the market becomes brutally efficient at separating the strong companies from the weak ones.
See, in a crash, all that hype and storytelling becomes worthless. What really matters are the cold, hard fundamentals. We're talking about things like positive free cash flow, which just means, does the company actually bring in more cash than it spends? Are they drowning in debt? And what about a product moat? Is their tech or their brand so strong that customers can't just easily leave them for a competitor? The companies that can tick these boxes, those are the ones that survive, while everyone else is sinking.
And this brings us to a really key player you see after a crash, the consolidator. Think about big tech companies like Cisco or Oracle after the dot-com bust. This is the company that's been patiently sitting on a giant pile of cash, just waiting. When the panic hits, they don't hide, they go shopping. They start buying up brilliant technology and even entire companies for pennies on the dollar, setting themselves up to absolutely dominate the next market cycle. All right, so once that initial wave of panic starts to fade and the survivors become a little more clear, where does the smart money start to flow? what sectors become the hidden gems in all the rubble.
One of the key things to get about a market panic is that it creates amazing bargains. In the frenzy, investors just sell everything. The good gets thrown out with the bad. And that means solid, boring sectors like healthcare or consumer staples, companies selling stuff people need no matter what, can get unfairly beaten down. And that can create some incredible buying opportunities.
Now, it is really important to remember that not all crashes are created equal. The future could hold something like a soft landing, which is painful for sure, but manageable. Or it could be a much more severe dot-com-style collapse. The key takeaway here is just understanding the whole spectrum of risk we could be facing.
And that brings us to our final thought. Tech bubbles bursting, they don't end innovation. They just reset the game board, right? After the dot-com crash, what do we get? Social media and the smartphone. So if this AI bubble does pop, the ultimate question isn't just about survival. It's about what comes next. What's the next great wave of innovation just waiting for its moment right around the corner?